Hi everyone, I'm James Harte from Littlefish FX, and welcome to today's live market analysis session where we're going to be discussing the upcoming ECB rate decision tomorrow. Now, having been fairly stagnant for several months now, we've seen a little volatility and momentum creeping back into the euro market over the last few weeks, and various reports have hit the wires concerning the ECB. So this month's meeting will be a key focal point for the markets and could provide the catalyst for further decisive moves in the euro. So ahead of the meeting tomorrow then, let's take a look at where we are currently and get some context going into the meeting. So post-Brexit, we've seen the euro dollar trading in a particularly stifled manner. From the initial post-Brexit lows, we ground higher as US dollar rate hike expectations receded and as ECB easing expectations receded also. So the key point out at this point is that over this initial period, markets were highly expectant that the ECB was going to ease based on their previous forward guidance issued both before and during Brexit, where they noted that they stood willing to provide a cushion of extra liquidity in the event of Brexit and would use all means necessary to backstop the economy. At their July meeting, however, the ECB downplayed the initial impact of Brexit and pointed to positive data, and instead of easing, they opted to adopt a wait and see mode, allowing for more time to pass before making a decision. Now, of those who thought that the bank were not going to ease in July, many were expecting that the ECB would at least give a signal of their intent to ease in future, with many signalling that the November meeting was a likely candidate for further ECB action. However, this was not the case, and subsequently we saw the euro trading higher as markets responded with disappointment to a less than forthcoming ECB. So as the summer months progressed then and we moved into the fall, euro was lent further support as key data prints continued to highlight the resilience of the eurozone economy in the wake of Brexit. Inflation particularly has been rising steadily over the last few months, moving to highs not seen since 2014. So this continued positive data has further weighed on ECB easing expectations. And in the bank's September meeting, the euro was once again boosted by comments noting that the ECB had not even discussed an extension of QE at that stage. However, the euro shortly after started to drift lower again as US rate hike expectations began to build. Fast forward to the last few weeks then, which is where the real volatility has crept back into the market. And the two key themes have been, first, the expectation of potential ECB tapering, and then expectations of an extension of QE. So we initially had reports that the ECB were considering tapering their quantitative easing program, which is due to end in March 2017. And this saw euro spiking higher initially, alongside a spike in 10-year yields on German, French, Italian, and Spanish paper. However, these reports were soon after dismissed by EC members, leading the euro lower. Indeed, following the dismissal of those reports, analysts are now changing their view and expect the ECB to announce an extension of their QE program beyond the March 2017 end date. Hence the sharp leg down which we've seen in the euro over recent days. So now that we've got a bit of context ahead of the meeting, let's talk about expectations for the October meeting. So ahead of the meeting then, expectations have now taken a distinctly dovish twist. Although markets aren't expecting that the bank are going to ease further at this meeting, they are expecting that the ECB will announce an extension of QE, or at least give a signal that an extension of QE is likely to come. The bank's recent reluctance to ease further, despite built-up easing expectations, is consistent with ECB Chief Draghi's previous comments about the diminishing returns of further easing and especially moving further deeper into negative rates. However, with Eurozone growth remaining sluggish, there is still a case for further ECB action. And indeed, looking at positioning into the meeting, you can see that institutional players have once again been building short positions. So you can see that short positions started to be unwound shortly after Brexit, as price was rebounding higher. However, over the last couple of weeks, we've seen institutions building short side positions again. So in terms of gauging possible market reaction to tomorrow's meeting, let's consider some different scenarios that we might see play out, which at the moment can be broadly seen as the following. So we have no further information being offered. We have an extension of QE by way of departure from the capital key, extension of QE by way of removal of the deposit rate floor, extension of QE by way of raising the ISIN issuer limit, and then finally we have the possibility of increased expectations of tapering. So let's talk first of all then about no further information being offered. Now, with much attention being given to the path of the ECB's quantitative easing program, markets are waiting for some clarity on the issue, with expectations now aligned to the bank announcing an extension, or indeed signaling that an extension is likely to be announced in the near term. However, in light of the ECB's recent stance, there is a risk that they offer no further detail at this stage. With the ECB scheduled to update their economic and inflation forecasts in December, there is the likelihood that they will choose to wait until then before making a decision on the path of QE. Markets' reaction then to recent ECB meetings has been much more subdued, given split expectations and really a lack of significant information from the ECB, which could once again be the situation this time around. Now, special attention will of course be paid to the press conference, which is likely to be much more market moving than the decision and statement itself. And of key importance will be questions posed to Mario Draghi regarding the possibility of tapering and QE tweaks. If Draghi refrains from offering info, there is a chance that concerns regarding possible tapering could enter the market again, leading to an appreciation of the euro. Similarly, if Draghi strongly dismisses claims of tapering or says that the ECB have not yet discussed such a move, then this is likely to further the euro's bearish path. And indeed, if we think about the immediate tightening in monetary conditions in response to the tapering talk which we got a couple of weeks ago, this will likely drive the need for the ECB to ensure a dovish tone to this meeting. Now, the next situation that we could see is a QE extension, or at least a clear signal of intention to extend QE in further. And this is likely to put immediate downside pressure on the euro and remove concerns regarding tapering. Now, within this scenario of a QE extension, there are three separate scenarios that we might consider. So the first of all is an extension of QE by way of departure from the capital key. Now, according to Reuters, there is a chance that the ECB could arrive at a compromise which allows for minor, single or temporary needs-based deviations from the capital key. If the ECB does point to the potential for a departure from the capital key, this would mean that the ECB would need to purchase fewer bunds and more peripheral bonds, leading to steeper bund yield curve and thus a lower euro dollar, alongside a narrowing of peripheral bond spreads. The second scenario then is an extension of QE by way of a removal of the deposit rate floor. So if the ECB suggests the potential for removing the deposit rate floor, this again would lead to a steepening of the bund curve, as the bank would need to purchase fewer super long-term bonds. Now, the impact on spreads would likely be smaller in this instance, though again, euro dollar should be weighed down in this event. The raising of the ISIN issuer limit, and you'll have to forgive me, I've missed out this slide. However, if the ECB suggests raising the ISIN issuer limit, then the bank will be able to purchase more euro area bonds. Now, this could still lead to a steeper bund curve and a lower euro through the impact on the curve, though the impact on the curve isn't as clear as with the first two options. So the reaction of the yield curve and peripheral spreads will simply depend on which, if any, the ECB suggests, leading to a mixed outcome for the euro too. So generally, a steeper curve leads to a weakening of the euro if the level of the curve is unchanged, as the euro tends to react more to the shorter end of the curve. Hence, the first two options, which could lower the yield curve with steepening, should translate into stronger euro downside. The likely effect of the third option isn't as clear, though receding concerns over tapering could still translate into a mild negative for the euro. And then finally the outsider scenario in this instance is if the market gets a sense of the likelihood of tapering, and this is most likely to come as a result of Draghi's comments during the press conference. So any indication of near-term tapering would take markets by surprise, and risk sentiment would likely be impacted negatively, with widening peripheral spreads further damaging risk sentiment. Now, it's less clear how a steepening of the curve in this scenario would affect the euro due to the euro's correlation with risk sentiment, whereby we've tended to see euro appreciation over periods of risk aversion. So in sum, it seems more likely at this stage that the ECB's next move will be an extension of QE rather than a tapering of it, leading to a weaker euro dollar rate. However, this time around, there is still the chance that the ECB refrains from offering any further clarity on the path of QE, ultimately leading to a muted market reaction. So, having looked at some of the different scenarios and discussed the possible market reactions to them, let's now assess the technical landscape ahead of tomorrow's meeting and get a sense of the opportunities that we have. So, kicking off first of all with the euro dollar then. So you can see that having broken down through the rising trendline support that's run from the December 2015 lows, price is currently stalled at key structural support at the June and July lows around the 109.60 level. And this is also around the 61.8% fib retracement from the lows to highs. So you can see the fib retracement comes in just below there. So this is a key pivot for the euro at the moment, and a breakdown below here opens up a test to much deeper support, and the level which we would then be looking at if price can sustain a break below these current lows is a completion of the larger ABCD pattern into around the 106.70 mark. So you can see we have that large symmetry projection completing down into this level, and this could potentially be a good buying zone depending on the price action we see once we get down there. Now, alternatively, another area which I would be interested in is actually a retest of the broken trend line. So if I just go ahead and get rid of some of these lines so it's a little bit clearer. So you can see we've broken down below that rising trend line support, but we have yet to trade back up and retest that. And the retest of these broken trend lines, especially long respected ones like this, can often be a really good opportunity to position for a rebound move. So what I'd be looking for is a move back up into a retest of that broken trend line. And you can see we have some further confluence here also, because we have a good ledge of prior support which was broken. So you can see this 111.20s level was held throughout August and September. We had 3 or 4 solid touches of this level. So if price can trade back up, retest that broken structural support, retest that broken trend line, and this is likely to be a good area to assess price action and look to position for shorts. And you can see that we also have some minor symmetry confluence there also, with the retracement from that last move equal to the gap between price now and a move back up into that level. So if price does trade back up into that level, I will be watching price action with a view to setting shorts. And you can see that we also have that bearish trend line resistance coming in overhead. So depending on the trajectory the price sustains, if we move back up into that level, we've got a good area of technical confluence suggesting that price is likely to reverse lower from that point. So these are the key areas I'm looking for on the euro then: a retest of the broken trend line support and broken structural support in line with this minor symmetry string around the 111.20 to 111.80 mark. So a good 60 pip range there. So I'll be watching price as we trade back up into that level. Alternatively, if we break to the downside here and move beyond these lows, then any traders playing the breakdown can look to target and move down into the completion of this larger ABCD pattern. And this is going to be an area which I'll be monitoring price action at with a view to maybe setting a medium-term position for a rotation higher. So some nice clear-cut levels on the euro. And as I say, after being stagnated for several months in the wake of Brexit, we finally got a little bit of momentum creeping back into the market with that breakdown last week through the rising trendline support. Though obviously for the time being, we're now stalled ahead of the ECB. And depending on what we hear from the ECB tomorrow, this could be the catalyst for the next directional move in the euro. Now, if we do see the ECB announce an extension of QE tomorrow, or indeed give a signal that they intend to extend QE in the upcoming months, then this is likely to create room for further upside in the dollar yen. So curve steepening by way of extending QE is likely to keep risk sentiment supported, and this should weigh on the traditional safe haven Japanese yen. Obviously, the current landscape of increased Fed rate hike expectations, as well as upward pressure on the US dollar via a weaker euro, should facilitate a proper breakout in the dollar yen. And you can see the current range which we have in place from the 100 lows to these 104, these mid 104 highs. So this has been sustained over recent months, and you can see that price has recently broken out above the bearish trendline resistance, which has run from earlier in the year, and we're now stalled at a test of that local structural resistance. So a test of the August high around the 104.40 mark. You can see that we pierced slightly just above it, but have since retraced. So for now, we're stalled just ahead of that key structural resistance. And so the clear move here is that if we do get an extension of QE, we're looking for the dollar yen to break out above this level, looking to set longs on the breakout above the 104.60s highs. And the target for that move will be a completion of the ABCD pattern into that level here. So you can see the completion of that symmetry move would take us up into the July high around 107.50. So this is likely to be a good area where we're going to see selling interest kick in, or at least profit taking from the long side. So any longs initiated over the 104.60 mark look to target a move up into 107.50s first instance. Now, in terms of a QE extension providing support for risk appetite whilst weighing on the euro, one clear vehicle which we can use to express negative euro sentiment is against the commodities block. So looking to sell the euro against commodities currencies. So if we pull up the euro Aussie here at the moment, you can see that price is currently breaking through some really long-term levels. So you can see we have this solid base of support between 143.19 and 144.30, which extends all the way back to June 2015. So we've broken down through the upper level of support at the 144.30 mark. We've broken down through that longer term rising trend line, and we've now broken down through the lower level of that support. So this is a good indication that the euro is starting to run away to the downside here, and dependent on what we hear from the ECB tomorrow, it could be the catalyst for the start of a trending phase in this market. Indeed, if we look at the broader technical landscape in the euro Aussie, you can see that we've got this large descending triangle pattern. So you can see that from the highs that we had last year, 2015, you can see that price action is beginning to put more and more pressure on the downside here. And we've got this descending triangle pattern. We've broken down through that rising trend line support, and we're now breaking down through key structural support. So if price can sustain this sell-off on the back of the ECB tomorrow, then the level that we should be looking at to the downside is a completion of this longer-term ABCD pattern into the 139.80 mark roughly. So between 143.20 and 139.80, we've got a lot of open water. So traders looking for short-term selling opportunities can look to get involved on the breakdown, targeting a move into that 139.80 mark. And then that's where I'll be looking to reassess price action with a view to buying. Now, obviously, in terms of fueling this move lower, we also have the Aussie, which has been given a bit of a boost over the last few days on the back of the release of the RBA meeting minutes, which showed that the bank is now comfortable with the current Aussie price. And this has led to a downshift in RBA easing expectations for the remainder of the year. So if the ECB do go out and announce an extension of QE, or at least give a signal of an extension of QE likely to be coming in the next few months, if the market gets a dovish sense from tomorrow's meeting, then the Euro Aussie is likely to quickly find its way down to that 39.80 level. Now, another good example of a strong commodities currency play that we can use is the Euro CAD. So again, if we do get the announcement of an extension of QE tomorrow, or dovish forward guidance from the bank, then you can see that the path to the downside is once again very clear here. So price has recently broken down through this rising trend line support, which has underpinned price action all of this year. And we're now breaking down through that big August low, the 143.74 mark. So if price does continue this path, then the move which we should have in mind as a target for selling is the completion of this symmetry swing, another ABCD completion, which trades all the way down into the December 2015 lows at around the 140.80 level. So again, if we do break down properly below here tomorrow on the back of the ECB, then a level which we can look for as a target on any short trades is symmetry completion back into this big low, the 2015 lows, December 2015 lows rather. Alternatively, this could be an area where we could look to position to the top side, dependent on the price action we see once we get down there. Now, what's interesting about this pair, and what is partly responsible for fueling this move at the moment, is that the Canadian dollar is currently receiving a lot of support from the rise in oil prices. And this suggests again that there is ample room for further upside in the Canadian dollar if oil prices can sustain a proper breakout. So just quickly pulling up the oil chart then. For those of you who were in the Q4 Outlook webinar, you'll remember that we highlighted this big inverse head and shoulders pattern in oil. So you can see we've got the left shoulder here around August 2015, the right shoulder here down into the year-to-date lows, the head, sorry, into the year-to-date lows, and then the right shoulder here in July of this year. So a really large technical reversal pattern, and the neckline sitting at the 5160s level is just being challenged at the moment. So this is the key pivot for this technical pattern. And if price sustains a breakout of 51.69, then this is likely to add further support for the Canadian dollar. And indeed, oil is strongly supported at the moment, and has been over recent weeks, on continued talks of a potential OPEC production cut deal, which was provisionally agreed at informal talks at the end of last month. Now, details are to be refined and confirmed at the upcoming OPEC meeting in November. But since those informal talks, we've had a lot of supportive comments coming, which has continued to boost oil prices. So we've had comments from Iran, who called on non-OPEC members to support the deal. And then we also had comments from Russian President Putin speaking in support of the deal, saying that Russia would even be open to a freeze. So if commentary leading up to the deal remains supportive and indeed a deal is agreed, then oil is likely to break out above this neckline and head higher, taking the Canadian dollar with it. And again, the target for a breakout in oil above that neckline area, the 150, 160s level, is a completion of that ABCD swing into the 64.90s mark. And ahead of it, you can see we have that big 2015 high at the 62.65. So we've got a good $10 worth of upside if oil can break out above this level. And that should translate into a much firmer Canadian dollar, which will, again, bring that Euro CAD trade nicely lower. Now, of course, we also have the Bank of Canada rate decision later today. And whilst the bank are largely expected to remain on hold, the statement is likely to be dovish following on from their September meeting, which saw the bank unexpectedly referring to downside risks to the outlook, which was a new addition to the bank's language. So if we do get any pop higher on the back of a dovish BOC, then one area which could be a particularly good location to set fresh shorts would be a retracement back up into this level of broken support between 146.12 and 146.40s. Now you can see we've also got the minor symmetry confluence here with that last swing before the sell-off taking us back up into that level. If we go ahead and put in our fib retracement from the highs to the lows, you can see we've also got 38.2% coming in here and the 50% retracement just above. So a good level of technical confluence here if we do get any pop higher. I'm not expecting that we're going to see a 300 pip move on the back of Bank of Canada today, unless they came out and cut rates. However, if the Bank of Canada are dovish today, and perhaps if we don't see anything forthcoming from the ECB tomorrow, then that could allow for a rotation higher in the EuroCAD. And indeed, in terms of just scoping out key levels to monitor over the coming days and weeks, then this is certainly one which I'll be looking at for an eventual breakdown, continued breakdown below that 143.70s low, which we're currently challenging, and then a move down to the December 2015 low at the 140.80 level. Now, on the flip side, if this meeting fails to dispel tapering concerns and we see further concern building in response, then this is likely to lead to a weakened risk appetite alongside higher bond yields and slowed foreign bond investment by European investors. Now, these steepening pressures would likely spread to other bond markets, thus exacerbating risk aversion, and consequently, we would see commodity currencies under pressure, whilst low-yielding, safe haven currencies, such as the Japanese yen, would be in demand. So if we do see any further tapering concerns on the back of the ECB meeting tomorrow, then a good pair which we could look at to take advantage of in this scenario would be the Kiwi yen. Now, the New Zealand dollar, being a commodity currency, is likely to weaken in this scenario, whilst the safe haven Japanese yen is set to appreciate. Now, what also supports downside bets in this pair is that the Reserve Bank of New Zealand are widely expected to cut rates further this year. And indeed, whilst the third quarter inflation figures released this week were better than expected, they were only in line with the RBNZ's own forecasts. And so inflation remains in the bottom of the bank's 1 to 3% target range, keeping them on course for further easing in line with recent comments by Assistant Governor McDermott. So again, if we do see any increase in tapering concerns tomorrow and we start to see that risk aversion creeping into the markets, then we could see a breakdown in the Kiwi yen. And you can see that for now, we're currently stalled at a test of the bearish trend line, which has been running from December 2015. So if price can reverse lower from here and we get a breakdown below the rising trend line support, then this could be a good pair to look to position in for continued downside. So I hope you're all clear now on the expectations ahead of tomorrow's meeting, what we're looking for, both in terms of messages and output from the ECB, but also in terms of key setups that we're monitoring in the technical landscape. So in the meantime, please feel free to head to the website www.littlefishfx.com to check out all of the great material we have on there, including our new live trading room, as well as daily trade ideas and daily Forex reports. You can use our gratitude coupon LFX Street 16 for 10% off our trade alerts, which are just coming to the end of their first year in live signals, and we've done over 3,000 pips. So if you're interested in getting daily trade alerts, you can go ahead and use that coupon to get 10% off. In the meantime, best of luck if you're trading the ECB tomorrow, and I look forward to catching up with you all next time. Cheers.